Hello, everyone. Are you gearing up for a finance interview or stepping into your first role in the finance industry? Then you've probably heard terms like CAPEX, OPEX, depreciation of amortization thrown around. Finance can be a maze of complex terms and jargon that often leaves people scratching their heads. But don't worry, we're here to help you make sense of it all. Today, we're explaining the 7 most confusing terms in finance to help you navigate the financial world with confidence. But first, please do me a favor. Hit that like button, share this video, and subscribe to our channel for more insightful career content. All right, let's get into it. First on our list is EBITDA versus net income. The former stands for earnings before interest, taxes, depreciation, and amortization. It's a measure of a company's operational performance by focusing purely on earnings from core business activities. Why exclude these expenses? By removing interest, taxes, and non-cash expenses like depreciation and amortization, EBITDA provides a clearer picture of operational efficiency. Imagine a manufacturing company that invested heavily in new equipment. Depreciation would significantly reduce net income, but EBITDA would show strong operational performance, highlighting the company's true earning potential from its operations. On the other hand, net income is the bottom line. The actual profit after all expenses have been deducted, including interest, taxes, depreciation, and amortization. It's important because it reflects the company's overall profitability and is essential for calculating earnings per share. Think of EBITDA as the company's earnings potential, while net income is what's actually left in the bank after all bills are paid. This is crucial when evaluating a company's financial health or comparing companies in the same industry. All right. Next up, liquidity and solvency, 2 concepts that assess a company's financial stability, but from different time perspectives. Liquidity refers to a firm's ability to meet its short-term obligations using its most liquid assets, those that can be quickly converted into cash without significant loss in value. Think of liquidity as your ability to pay your bills this month using the cash in your checking account. For example, a retailer needs sufficient liquidity to pay suppliers and cover payroll, especially during slow sales periods. Solvency, however, is about the company's ability to meet its long-term obligations and continue operations into the future. It assesses whether a company's cash flow is sufficient to meet long-term liabilities, such as loans or bond repayments. Consider a utility company with significant infrastructure investments. Even if it's profitable, high debt levels can threaten its solvency if it cannot meet long-term debt obligations. Understanding both liquidity and solvency is essential for assessing a company's overall financial health. Liquidity ensures day-to-day operations run smoothly, while solvency ensures the company's long-term survival and growth. Moving on to CAPEX and OPEX, which stand for capital expenditures and operating expenses respectively. CAPEX refers to funds used by a company to acquire, upgrade, or maintain physical assets like property, industrial buildings, or equipment. These are long-term investments that will benefit the company for more than one accounting period. For example, buying new machinery for a factory or investing in a new office building are considered CAPEX. These expenditures are capitalized and depreciated over time, affecting both the balance sheet and income statement. On the other hand, OPEX are the expenses a company incurs through its normal business operations, such as rent, utilities, and salaries. These costs are necessary for the day-to-day functioning of the business. For instance, monthly electricity bills, office supplies, and employee wages are OPEX. They are fully deducted from revenue in the accounting period they are incurred. Understanding the distinction between CAPEX and OPEX is crucial because it affects financial statements, tax implications, and cash flow analysis. Misclassifying expenses can distort a company's financial health and performance metrics. Next up, we have ROI and ROE. Both measures of profitability, but with different focuses. Return on investment, ROI, measures how much profit an investment generates relative to its cost. If you invest $1,000 in a project and earn $1,100, your ROI is 10%. ROE, or return on equity, measures a company's profitability by revealing how much profit a company generates with the money shareholders have invested. It assesses how effectively a company uses equity financing to generate profits. For instance, if a company has a net income of $500,000, and shareholders' equity of $2,500,000, the ROE is $500,000 divided by $2,500,000, which equals 20%. Understanding both ROI and ROE is essential in finance roles. ROI helps evaluate the efficiency of individual investments, while ROE assesses the overall profitability relative to shareholders' equity. Now, let's differentiate between depreciation and amortization, both methods of allocating costs over time. Depreciation is the systematic reduction of the recorded cost of a tangible fixed asset over its useful life. It applies to physical assets like machinery, vehicles, and buildings. For example, if a company buys a delivery truck for $50,000 with an expected useful life of 10 years, it might depreciate $5,000 annually using the straight-line method. Amortization is similar, but applies to intangible assets and the repayment of loan principal over time. It involves spreading out the cost of an intangible asset over its useful life. For instance, if a company acquires a patent for $20,000 with a useful life of 5 years, it amortizes $4,000 annually. Understanding these concepts is crucial for accurate financial reporting and analysis. Both depreciation and amortization affect a company's financial statements by spreading costs over time, impacting net income and tax liabilities. Let's explore market capitalization and enterprise value, EV, two ways to value a company. Market capitalization, or market cap, is the total value of a company's outstanding shares of stock. It's calculated by multiplying the share price by the number of outstanding shares. For example, if a company has 1 million shares outstanding at $50 each, the market cap is $50 million. Enterprise value provides a more comprehensive valuation by including debt and subtracting cash. The formula is EV equals market cap plus total debt minus cash and cash equivalents. Using our example, if the company has $10 million in debt and $5 million in cash, the EV would be $50 million plus $10 million minus $5 million, which equals $55 million. Understanding the difference between market cap and enterprise value is important. Market cap reflects equity value, while EV accounts for the entire value of the company, including debt and cash, providing a more accurate picture for potential acquirers or investors. Finally, let's differentiate annuity and perpetuity. An annuity is a series of equal payments made at regular intervals over a specified period. Common examples include retirement pensions, mortgage payments, or insurance payouts. For instance, a retirement plan that pays you $5,000 annually for 20 years is an annuity. On the other hand, a perpetuity is an infinite series of equal payments with no end date. It's a theoretical concept often used in valuation models. An example of a perpetuity is a preferred stock that pays a fixed dividend indefinitely. Understanding these concepts is essential in finance, especially when calculating the present value of cash flows for valuation and investment analysis. And there you have it, the 7 most confusing terms in finance now clarified and explained. Please be sure to like this video, subscribe to the channel, and activate notifications. And if you wish to get job ready for a successful career in finance, don't miss the opportunity to subscribe to the 365 Financial Analyst platform. Stay tuned.